that inflation is a cumulative phenomenon, and prices have already risen dramatically enough to increase the cost of living of your average family over the past 2 years by about $11,000. But nope, we're just going to hear about how the rate of inflation is coming down and how this is a good sign in the Fed's fight. A little bit about the numbers here. The index for shelter in November moving higher, so it's getting more expensive to find a place to live. However, the decline in the price of gasoline is kind of offsetting that. That seems to be the only thing really saving the CPI right now is the declining price of oil, which we're going to talk about in just a moment. Food also moving higher. The all items less food and energy index, so that's the core CPI, up 4% over the last 12 months. Same deal as in October, so we're still well off of the Fed's 2% target here. The energy index has decreased by 5.4% year over year. Food getting more expensive, increasing 2.9%. Okay, so anybody feel like their grocery bill has increased by 2.9% over the last year? That seems a pretty conservative estimate, if you ask me. Put a 1 in the chat if your food bill has gone up more than 2.9% over the past year. But that's what we get from the BLS. So, more of the same there, really. Now, I want to talk about crude oil real quick before we get into the soaring budget deficits and the coming economic recession. So, crude oil, back in October, I had said that I believe the price of crude oil was going to rise. But if we zoom out to the 3-month chart here, you can see that that has not been the case. Of course, my forecast there was predicated upon a escalating conflict in the Middle East, which thankfully, up until this point, we have avoided. The factors that are driving the price of crude oil here seem to be sort of a mixed bag. You've got U.S. oil production at a record high. You have OPEC, on the other hand, trying to cut the supply, making production cuts, trying to elevate the cost. And then the other thing is that we have the risk of a Middle East conflict expanding. So you would think that that might kind of shift the balance in favor of higher oil prices. But to me, the fact that the price has been declining here, what that indicates is that investors and markets are pricing in a massive economic decline here in the U.S. and demand destruction. However, we should not discount the fact that the Middle East remains a hotbed and could explode at any time. I want to cover a few stories from that, and then we're going to get into some more economic stuff. We've got the Houthis now today, newest development, hitting a biofuel tanker with an anti-ship missile. So we've seen hijackings, drone attacks, and now an anti-ship missile striking this tanker, causing a large fire on board. Now, French ships moved in to prevent anybody from boarding this ship, and also they shot down some drones. But to anybody out there who thinks that the possibility of a significant escalation here is off the table, it seems to be that things are actually escalating as the days go by. And should we see, let's say, attacks on more oil tankers, there is still the possibility for a significant increase in the price of crude oil as a result of this. But the fact that these escalations are occurring and the price of crude oil is still falling down, if we look at the daily chart, actually on that news, you see there was this little spike in oil when that attack was reported, but it came right back down. So what does that tell you? I mean, what does it tell you about the level of demand destruction in the global economy and how weak the economy is becoming, that despite the fact there's this raging conflict and the risk for the disruption to global supply chains for fossil fuels, we're still seeing the price declining. I mean, that should give you a clue as to where we are headed here. Also, you've got Israel now pumping seawater into Hamas's Gaza tunnels. I'm not going to linger on this issue too much, but this is something that Russia has described as a war crime. So, it shows you that there's still the potential for significant escalation here, not just with the Houthis, but with the Russians, with their Iranian allies. And that, of course, will be the real tipping point for the oil market should that occur. Hopefully it doesn't. I would prefer oil to be lower myself because I buy lots of things which oil is an input for, and I drive my car around. So, falling oil is actually, I think, good news for consumers, but I'm afraid that it is one that we may not be able to benefit from for too much longer, depending on how this conflict goes. Now, this is a story that I'm sure will come as no surprise to anybody, but it is still very notable. U.S. budget deficit hits record high for November on soaring interest costs. So this is a real problem, and it's one that is going to continue to worsen as long as the Federal Reserve maintains their policy of tighter monetary policy and their higher rates, because every month more and more lower yielding U.S. Treasuries are maturing and they are rolling over to the current higher interest rate. So the interest cost is going to continue moving up. Of course, also, there's a lot more spending. It's not just interest which is driving these deficits so much higher. But think about that, a record high for the month of November, a $314 billion deficit in 1 month. So, the debt is going to get a lot bigger at that pace. That's all I really have to say about that. Look at this. It was a 9% increase, actually, in federal revenues in November. But despite that fact, deficits still increased by 26% over the previous years. So the debt is going to get much larger. And speaking of interest rates, let's talk about what the Fed is going to be doing tomorrow. We got a Fed meeting tomorrow, probably going to be one of the most boring meetings we have seen in some time. I'm sure, again, we're going to get Powell paying some lip service to the inflation numbers, trying to act as if a 4% core CPI is something to celebrate. However, see from the CME FedWatch tool, a 98.2% chance of the Fed just keeping rates where they are. It's almost guaranteed what's going to happen. There's a 1.8% chance of further hikes, but I don't think Powell would be that foolish given the weakness which we are seeing in the economy. In fact, I tend to think that the Fed is going to cut before they hike. I think the hikes are in at this point, and we're continuing to see signs of weakness. It's not just reflected in the lower cost of oil. Look at this story from AP. Hasbro cuts 1,100 jobs. That's 20% of its workforce. This is prompted by the ongoing malaise in the toy business. Well, think about this. This is right before Christmas, right before the holidays. You'd think the toy business would be booming. But that is simply not what we are seeing. So according to this report here, toy sales in the U.S. were down 8% from January through August. And according to the CEO of Hasbro, he said the market headwinds we anticipated have proven to be stronger and more persistent than planned. While we have made some important progress across our organization, the headwinds we saw through the first 9 months of the year have continued into the holiday and are likely to persist into 2024. Another sign of a massive economic slowdown coming, a massive job market hit, which is coming for 2024. I mean, they're going to keep laying off toy workers if people stop buying toys. And as the consumer is tremendously, broke, can you say tremendously broke? I mean, they're coming under tremendous pressure and they're incredibly broke at this point. They're not going to be buying toys. I mean, sure, it might be Christmas. I don't know what you do. Maybe you buy a secondhand toy. You got to buy toys sometimes. I like to give things like, a silver bar, a silver coin for a Christmas gift, if you ask me, to the kids. I can tell you this, I don't think I have any of the toys that I was ever given as a child, but I do still have a silver bar, which I was given when I was 7 or 8 years old. I think it was one Christmas, and I still have that to this day, and, it's still worth something. So just a thought, when you're buying toys or gifts this Christmas, what you might want to consider getting for some of the kids in your family or friends, whatever, and get them a silver bar or a coin might be something that they might learn a little something from. I guarantee you they're going to like it. And it's something they actually will probably hang on to longer than any of the plastic crap that is manufactured overseas. So anyway, here's one from Yahoo Finance. A severe recession may be coming in 2024 as the stock market, job market flash warning sign, strategist says. Let's listen to what this guy had to say. This is Briley Wealth's Paul Dietrich. Says the U.S. could be in for a severe recession in early 2024. Why? Well, he says investors shouldn't count on the central bank lowering borrowing costs unless the U.S. economy falls into a severe recession, which may happen early next year. The Fed typically starts cutting rates when there is a sharply slowing economy and rising unemployment, meeting a recession. And though the overall unemployment rate ticked lower in November, continuing unemployment claims briefly rose to 1.93 million last month. That's the highest counting claims to have that's the highest continuing claims have been since late 2021. So, you can't always believe the numbers that the powers that be, the elites, pick and choose when they want to talk about how strong the job numbers are. Rising unemployment claims. A lot of those jobs that have been added, we know are second or third jobs. And so, the job market is not as strong as Powell is going to tell you tomorrow. And it is probably going to get a lot worse in 2024. But listen, you don't have to take this guy's word for it. Paul Dietrich, if you want a really good indicator that there's going to be a recession, probably better than any other analysis you're going to get. And this is one that really convinces me we will have a recession. We've got Janet Yellen, who says there's no solid intellectual basis for seeing recession as inevitable. Well, as far as I'm concerned, that seals it. A recession is on its way. Let's see what she had to say here from MarketWatch. A year ago, I think many economists were saying a recession was inevitable. She said this in an interview at the Wall Street Journal CEO Council Summit. She added that she had never felt that there was a solid intellectual basis for making such a prediction because a key is that inflation expectations never meaningfully ratcheted up on a long-term basis. She also said the Treasury Secretary sounded upbeat about making further progress on reducing inflation. I personally don't see any good reason to think that the last mile is going to be especially difficult regarding that inflation fight. But it probably won't be if you manage to eviscerate the U.S. economy, which is what is happening with the Fed's program of rate hikes. The consumer is being destroyed. Consumer, who is a major contributor to GDP, we are seeing many types of debt rising in delinquency here as rates go up. The deficits are soaring on the interest costs. But no, Janet, there's nothing to worry about here. Nothing to worry about at all. Let me know if you think Janet Yellen is correct. Let me know in the chat. If you disagree, let me know that too. I'd like to know what you have to say. But to me, she has become a very reliable contrarian indicator. And I'm being a little kind of sarcastic with that, but really, this is the same lady who told us that she didn't think there would be another financial crisis in her lifetime. She's also the one who told Congress that we didn't need to worry about the level of the U.S. debt. We only had to worry about the cost of servicing it. And at the time, she said, well, interest rates are low now. Well, what are they doing now? Are they still low, Janet? No, they're not. Cost of servicing the U.S. debt is driving deficits to a record high, and employers are laying off their employees. So what is 2024 going to bring? I believe it will bring a recession. What does that mean? Well, keep in mind, it's not only a recession, but it's a recession in an election year. What does the Fed usually do when the economy begins to weaken? Well, as Dietrich said there, that analyst, they begin to cut rates. But also, that doesn't tend to work out too well. I mean, look where we began to cut rates, or where the Fed began to cut rates. This is the federal effective funds rate here. They began cutting in August of 2007, and yet that didn't manage to avert the massive economic slowdown of 2008 and 2009. They ended up cutting almost all the way down to zero. I suspect that this crisis will be larger than that one. Now, they're not just going to have to cut rates, they're also going to have to actually get into these markets and buy up assets. We probably will see rates head towards zero once again. And when that happens, the price of gold and silver is one asset that I believe will react very favorably to that. And that is why, gold here at $1,980, I view this as a significant buying opportunity. I mean, it was just last week we had gold up to $2,150, record price in overnight trading. Now, I'm not telling you what to do with your money. This is not financial advice, but I am looking at 1980 gold as pretty cheap. Could it drop lower? 100% it could. There's no guarantees of that. I believe that we have now kind of stabilized here under 2,000. I think we'll be back above 2,000 sometime soon. If there's a massive economic crisis, a massive deflationary event, maybe you might see this price spike down. That's okay. I would try to snap it up. But look, I don't really feel comfortable waiting for that. Sure, is it okay to have some dry powder in case you get some kind of a crash? Absolutely. But for the most part, I want to be early to the party with the precious metals, not late. We can look at the weekly chart here, and we will see the formation we've talked about extensively here, this large cup and handle formation. You can see to really invalidate this formation, you would need to get a drop below 1,600, and I just don't think that's going to happen. Maybe you see that in the paper markets, even in the event of a major recessionary collapse, a deflationary collapse. I think that would probably be the low point for gold. Very, very unlikely real prices for physical metal will drop below that. Of course, what do I know? Anything can happen. That's just my take on it. But I don't really see it even dropping much lower than it is at the moment. Anything can happen, though. So, let's wait and see. But one thing I think is for sure, once the Fed is forced into asset purchases, once they are forced into slashing rates as a result of a massive recessionary collapse, massive deflationary collapse here in the U.S., which I believe could very well be coming in 2024, the price of gold and silver will be moving much higher. Gold's chart is looking very good. It will bring silver along for the ride, and probably at the end of that bull market, I believe silver will outperform even gold. So let me know what you think in the comments down below. Thanks for watching, everybody. Don't forget to smash that like button, subscribe to the channel, share this one with your friends, and I will catch you next time. Smart Silver Stacker